Thank you very much, everyone, for joining us today. If you do have any questions, again, please do make sure you type those into the chat box. I will address those as they come up. My name is Alex Perny, and I will be covering today on how health savings accounts work and how you can utilize those in your self-directed plan to invest in alternative assets, and a little bit of the history of these plans as well, because especially pertinent to right now, we have open enrollment for the Affordable Care Act coming up. It starts on Sunday and rolls through the middle of December. So if you're looking to change your healthcare coverage or get into a high deductible healthcare plan that allows for HSA coverage, and we'll get into what exactly those kind of plans are. And at the end of the day, I always will repeat this throughout the entirety of the presentation. It is important to note that if you want to know if your plan has HSA, is HSA eligible, you need to contact your healthcare plan provider. I can go through the metrics of what exactly it means to calculate your high deductible healthcare and see if your plan looks like it has ability to be used with an HSA, but at the end of the day, you really need to check with that high deductible or that healthcare plan provider. So if it's someone like Cigna or Blue Cross Blue Shield or United Health, those are the people you need to contact, not your necessarily primary care provider or someone like me. You really need to contact them to see if you are able to use a HSA, and then I can certainly answer any questions that you might have with regard to utilizing those investments, making contributions, how to reimburse yourself for expenses, and the like. So we'll go ahead and get started here. A little bit of a disclaimer before we get into everything. Advanta IRA and our employees, we do not provide investment advice, nor do we endorse any investment products. All information and materials today are for educational purposes only. All parties are encouraged to consult with their attorneys, accountants, and financial advisors before entering into any type of investment. Now, with that said, what exactly is an HSA? Most people are familiar with an HSA, or they think they're familiar with an HSA, and we'll get into that in a little bit later on in the presentation. But an HSA, in its most empirically defined term, is a tax advantage savings account for individuals with high deductible healthcare plans. And throughout the presentation, I'm going to be referring to those as HDHPs that can be used for a wide variety of future medical expenses. We'll get into the medical expenses as well. But if you hear me refer to something as an HDHP, I'm referring to the type of healthcare coverage you have. So again, remember that is what is being provided to you from a company like United Health, Cigna, Blue Cross Blue Shield. That is the provider of the high deductible healthcare plan, or HDHP, when you hear me refer to it in this presentation. Now, it's important to understand kind of where we came from to understand where we are at presently with HSAs, because they have had a lot of different iterations throughout the years. And for about the past 37 years or so, 36 years, we've had a wide variety of different attempts by our legislators to kind of get it right with regards to being able to give people tax advantaged savings accounts for healthcare costs. One thing that is what is universally kind of agreed upon in our country is healthcare is expensive. No matter where you fall on any spectrum, healthcare costs money. It is an expense that is needs to be accounted for in almost every single household, and being able to save for those types of events and being able to get a tax advantaged way to do it has been on the radar of people for almost the better part of 40 years. So back in 1984, the National Center for Policy Analysis kind of identified that need, but it kind of took until about 1992 for Congress to pass some type of savings account into the actual bills that were being argued on. Now, it's until 1996 is when we finally get the Archer MSA plan, which is the first predecessor and kind of the early adoption of the HSA. It introduces contributions to these plans are made by employers, but were subject to payroll and income taxes to the employees, and the monies couldn't be rolled over from year to year. So the employer is contributing to the plan, the employee is paying taxes on those funds that are going in, but you don't get to roll it over from year to year, and you also don't get to take it from job to job. So if you had an Archer MSA that you paid taxes on at one job and you move to another one, you kind of use or lose it. Now, there is still a type of plan like that with regards to the HRA. Now, the HRA is what a lot of people might erroneously think is an HSA. That is, or that was legislated into existence in 2002. Now, this plan is what a lot of people are familiar with when your healthcare provider provides you with a preloaded debit card saying, hey, you have $1,500 a year, every year on this to use for discretionary spending. Typically, these are the cheaper of about 3 options that you're going to get from your employer with regard to your healthcare plan. Now, obviously, this is going to differ slightly if you are participating in the Affordable Care Act and marketplace coverage. But for those of you that are looking to change your coverage at an employer, you're typically given about 3 different plans. One is going to be your super cheap, high deductible, typically HSA qualifying plan. The middle one will be the HRA, which again came back in 2002, and the the lowest deductible, highest coverage amount, most expensive plan is going to be a non-HSA, non-HRA, low deductible, high coverage plan, although that does include significant costs. Now, HSA is created to allow portability from job to job and can be rolled over to accumulate funds for non-health reasons as well. So in 2003, we get the first iteration of the HSA, which is, again, different from the HRA in that you can contribute personally to it and then your balances are not lost when you switch employers. So again, the Archer MSA was kind of the first iteration of it. They really aren't in existence anymore. I think we don't even have any held at Advanta anymore, but it's important to understand that if you still have one, they are still able to be used, but you know, they phased out of existence about 15 years ago, but you can still have one if you had one before 2005. Now, FSAs or flexible spending accounts are something I do want to cover because flexible spending accounts and HRAs are kind of merged into one and the same with regards to healthcare coverage now. So these are types of accounts where, again, your healthcare provider, if you signed up through your job, will provide you with a debit card that you can use for other expenses that are not covered by the healthcare plan. It's kind of that middle option that you can choose that maybe doesn't have deductibles as high as the HSA qualifying plan, and certainly isn't as cheap as it, but it's kind of that nice middle ground but from the most expensive plan that's typically offered. Now, these, again, remember, do not port from job to job. You can carry over up to $500 per year in these, so you can have balances depending on how much that are put in there that are use or lose depending on how much is in there and how much you're using. And the maximum contribution is going to be $2,750 by the employer into that plan per year. And again, remember, you can have up to $500 carry over, so you have $3,250 that could potentially be in there every year for you to use on things that are not paid by insurance, including deductibles, co-pays, co-insurance, things like that, you know, and procedures as well. A personal anecdote, I had to have a MRI done on a shoulder injury not too long ago, and I used my flexible spending account funds to directly pay for that. I didn't come out of pocket. I didn't have to pay anything, but keep in mind that is going to be different than an HSA where I would have paid out of pocket and then reimbursed myself. So the flexible spending account is contributed to on behalf of on the employee's behalf by the employer for payments of things not covered. But the FSA is going to be something that you do not take out of pocket and you use to pay that is provided to by the plan. It's by the employer itself. So the benefits of an HSA. The government's encouraging better spending habits with regard to your healthcare. The theory is that if you are spending your own money, you will make better decisions and do more research onto the procedures that you are receiving or the care that you are seeking out. Now, whether or not someone agrees with this is kind of, varies widely across the board. But the good thing is that the legislation regarding these gives you a wide array of options for how you reimburse yourself with HSA funds and what you can use the HSA funds to reimburse yourself for. Now, keep in mind that an HSA is a special savings account just for health expenses. There are some exceptions to that, and we'll get into that later with regard to your age and what you're reimbursing yourself for and the taxable implications of that. And it is used as a supplement to your health insurance coverage. So in order to have an HSA, you have to have qualifying HDHP coverage. So keep that in mind. Just because you want an HSA or you think that it would be a great idea to get a tax advantage savings account to pay for your medical expenses, you cannot be an uninsured individual and start and contribute to an HSA. Although if you do lose your high deductible healthcare coverage or you change to a different type of coverage or become uninsured, you do not have to distribute the HSA. You can keep it in existence in perpetuity, for as long as you'd like, but just keep in mind that your contributions are going to be limited, and if you do not have one, your ability to establish one is going to be restricted. Now, these are great plans because they are portable, so if you switch employers, you can take it with you. The contributions are tax deductible, just like a traditional IRA. You get tax-free growth on your investments, just like an IRA, and tax-free distributions for qualifying medical expenses, just like a Roth IRA. So you get a lot of benefits of both your deductible and non-deductible contribution basis plans like Roth and traditional IRAs. And remember, these supplement your high deductible healthcare coverage and allow for payment of non-covered medical expenses with tax-deductible money in a tax-free distributable manner. So here's some benefits of an HSA. So you contribute $3,550 of earnings to the HSA. You get a deduction on your income tax return. So at a 20% tax bracket, that's a tax savings of $710. You can now distribute up to $3,550 tax-free to pay for health insurance or to pay for health expenses, and any unused funds grow tax-free. So now in this same example, you have $3,550 out of pocket. So this is after tax to pay for health expenses. You would have had to have had $4,400 of earnings to have take-home cash of $3,550. Remember, you're assuming that it's going to be paid in a 20% tax bracket to end up with a $3,550. And any future earnings on any of those unused funds are also going to be taxed at capital gains. Again, just assuming how you are investing those funds or how you have those invested. They can be taxed at a few different rates, but the most tax advantageous would obviously be a capital gains rate. So just to show you, that is a $710 difference just right off the bat if you have an HSA for paying for medical expenses, and then also the ability to have the entirety of those basis of funds grow tax exempt is a very enticing offer, at least in my opinion, when it comes to whether or not that the higher deductibles that you have for an HSA type plan really outweigh the potential cost of having a higher coverage plan. Now, obviously, you need to take in your personal health and the health of those that are being covered by the plan to see if it would be advantageous. But for the majority of people, if you're relatively healthy, an HSA qualifying plan can be a very attractive offer. So now there are two different types of HSA accounts. There are individual HSA accounts and family HSA accounts. Now, we'll get into this in a little bit more detail, but it's relatively simple on face value. An individual HSA is going to be covering just the sole holder of that HDHP plan. So that means that if you have sole coverage for yourself with a qualifying HDHP, you can have an individual HSA. Now, if you are married and have dependents, if they are not covered by that HDHP, let's say your spouse has coverage at their particular job, and your dependents are covered by their coverage and you are the only one covered by the HDHP in that household, then you can only use the funds from that HSA to reimburse expenses directly related to your healthcare cost. Not any costs associated with your spouse or your dependents can be used for those reimbursements. So the self-only coverage limit is going to be, for the self-only coverage deductible must be at least $1,400, and the self-out-of-pocket maximum must be $6,900. Now, for those of you that are thinking, well, wow, when I look at the marketplace plans, those are really not what most people would call high deductible. And in reality, for most healthcare plans in today's market, they really aren't. But we'll get into some of the caveats that really kind of carve out what exactly it means to be an HSA qualifying plan, and then you'll see, wow, well, now with the Affordable Care Act in the marketplace and the healthcare marketplace, you will see that a lot of plans, even if they do absolutely have out-of-pocket maximums and deductibles that meet the criteria of the family or individual HSA, they'll have things baked in that will preclude it from being an HSA qualifying plan. Now, for a family HSA, it is kind of the difference between individual and family is relatively simple. If you have qualifying HDHP coverage that covers your spouse and any dependents, then you get a slightly higher contribution maximum for those plans, and then you also get the ability and the deductibles and the out-of-pocket maximums go up a little bit as well. But keep in mind that the dependents and the spouse have to be covered to have the family HSA for the higher contribution limits in order to be able to qualify for that type of plan. So just because you maybe have a family, you have to have them covered by the HDHP in order to be able to have a family HSA, because your contribution limits are going to be higher for a family HSA. But just because you are married with dependents, even if you are the only one covered by the HDHP, you have to contribute at an individual rate. So here are the 4 requirements for having an HSA. Remember, just because you have a plan that maybe on face value meets the criteria of seeing the deductibles, it definitely is not always going to be able to be utilized by you, because certain things might be baked into that plan, or you might be enrolled in other things that would preclude you from having an HSA. So the plan specifically, you can have no copays for office visits other than preventative care, annual physicals, prenatal, well child immunizations, and certain screenings, or prescription drugs until you meet your deductible. That means that you have to be paying out of pocket towards your deductible for these things at actual billed rates until you meet your deductible. There is no type of co-insurance that can be had for offices. If you get sick and you get the flu, or God forbid you get COVID or something like that, if you have a plan that requires a copay for an office visit outside of a preventative care annual physical, then that is not going to be qualifying HDHP coverage. Remember, for 2020, self-only coverage deductibles must be at least $1,400 and family coverage $2,800. So it's just a multiple of 2 going between the 2. And then your out-of-pocket maximums, again, are just doubled. So self-only coverage has to be an out-of-pocket maximum of $8,150, and then family coverage is $16,300. You cannot have other health coverage, meaning that you cannot have another type of supplement coverage to your existing HDHP besides vision, dental, workman's comp, long-term, or disability insurance. So you cannot have another health plan that additionally covers you, such as Medicare, which is kind of the big one that most people think of. Most people don't think, well, hey, I can have 2 different medical insurances. But when people kind of fail to realize is that if they get to the age of Medicare, that is another type of healthcare insurance. So if you are still maintaining an HDHP and supplement coverage to Medicare, you cannot, even if that supplement coverage might qualify in the out-of-pockets for your HDHP coverage for an HSA, you are precluded from having an HSA because you are enrolled in Medicare, which is an additional type of insurance. Looks like we have a question. Again, for anyone that kind of filed in, feel free to shoot a question in, even if it's not been covered yet, or you just want to make sure it gets out. Maybe you have to leave early, shoot it in there. I will try to address them as they come up. But we have one from Cheryl here. Is small group coverage the same as individual requirement regarding HSAs? So when it comes to individual requirements, that's referring to spouses and dependents. So if you are covered in a small group coverage, typically you're referring to like a small office or like a small group of people, but you have to have some type of familial relation. They have to be covered they have to be claimed as a dependent or a spouse in order for you to be able to bump into the family HSA. So if you have small group coverage and you are the only one of that type covered in that group, and you do meet all of the other terms for an HSA, then yes, you should be able to have, you should be able to establish and fund an HSA. Now, keep in mind, I will always kind of refer back to this, is that at the end of the day, you need to contact that healthcare provider and ask if it's HSA qualifying coverage, because they ultimately will be the ones legally that have to know the answer to that question. They're on the hook, according to portions of the Affordable Care Act, to be able to provide that information to their covered individuals with regards to the supplements that they can have with coverage that is bound by that company. So, it's good to kind of start the conversation here, but you ultimately do need to end it with them. And again, it's just a simple question of saying, hey, Blue Cross Blue Shield, United Health, hey, is this coverage that I have for my small group coverage, is that HSA qualifying for me and any dependents or the like? So just give them a call, but a great question. Thanks for asking. All right. So you can't be enrolled in Medicare and you cannot be claimed as someone else's dependent. So if you want to have HSA coverage, and really this, probably isn't going to be coming into play a lot with most people. If you are buying your own healthcare coverage, typically, you are not claimed as a dependent. You're independent enough not to be claimed as one. But in any regard, if you are, for whatever reason, claimed as a dependent, you cannot establish an HSA. So remember, you have to have qualifying HDHP coverage. You cannot have other health coverage besides supplements like health, vision, and dental. You can't be enrolled in Medicare, and you cannot be claimed as someone else's dependent. All right, great question. Maria asks, can I set up an HSA if I'm self-employed? Absolutely. It only just comes down to what type of healthcare coverage you have. So the nice thing about an HSA is that it's different from the HRA, the health reimbursement account, in that it's not tied to an employer sponsored medical plan. So if you're self-employed and you purchase your own healthcare coverage and it meets the 4 criteria that are up there right now, absolutely, you can certainly have HSA coverage. But keep in mind that you have to make sure that it's HSA qualifying coverage. It doesn't matter if you're self-employed or not, because your contributions come out of your personal earnings. So whatever you have as your take-home pay before you, pay your taxes every year, that is the money that you're going to be able to use to contribute to these types of plans. Let's see. We got great questions filing in. Let's go ahead and fire these out before we get into the next portion of it. Let's see. Stephanie asks, I assume the same applies to retired people. Yeah, you can, so long as if you're retired and if you're of retirement age and you can be covered by Medicare and you elect to purchase your own healthcare coverage as opposed to being enrolled in Medicare, yes, you can have an HSA. Let's say you decide to switch when you're retired back over to Medicare, you can continue your HSA coverage. You just can no longer contribute to that plan, but you can still use it to reimburse yourself from expenses incurred while you did have the qualifying HDHP coverage. So retirement doesn't really have any bearing on your ability to have, establish, and fund an HSA. Really, the thing in retirement that is the big question is whether or not you are enrolled in Medicare. And let's see, Maria asked, can I offer an HSA to my employee? So that question needs a little bit more unpacking. Can you offer a plan, a workplace sponsored plan that allows for HSA coverage? Yeah, absolutely. For personal example, my wife's company, who I have my healthcare coverage through, has 3 different options. They have a very expensive option that has very low deductibles and high coverage for basically covers everything. You have to pay a cent out of pocket, but it's very expensive per paycheck. They have the HRA, the health reimbursement or flexible spending account. So HRA, FSA, where the company or the healthcare provider provides you like a preloaded debit card with X amount of dollars a year that you can carry over $500 a year. That's not HSA, but that's what we chose. And then they have the cheapest option, which is HSA qualifying coverage. So they provide us a wide variety of different options for coverage. So if you'd like to offer that, you would need to contact a healthcare provider like United Health to put together some type of package, and then they could put together something for you that would allow for you to offer HSA coverage to your employees. Let's see, Connie, are there a link to the slides? If you would like a copy, we can certainly email you a copy. Just contact me afterwards and I can send you a link, or I can send you a PDF copy of everything. So I think that answers the questions we got right now. Thank you very much for asking them. Let's continue. Okay, So HSAs, they are a little tricky, and they have their own special sets of rules. This is one of the kind of tricky ones to understand, but it's really not terribly complicated. First day of the last month rule. Now, unfortunately, this is kind of coming up a little close on the first day of the last month. You know, we have just right around 30 days and change until December 1st, which is what this would be referring to. So if you want to make a full year's contribution to an HSA, you have to have the coverage bound for a new HSA by the first day of the last month, meaning 12/1. So what does this mean? So if you want to make a contribution of $3,500 or $6,900, which are the two HSA contribution limits for family or individual, you have to have that high deductible healthcare plan in place by 12/1, and then you can make a full contribution for the year of 2020 up until your filing deadline the following year. So next year, assuming that the filing deadline does not get moved such as it did this year, you would have until April 15th to make your contribution. Now, the interesting thing of that is that with this rule, you have to then in turn maintain that coverage for a full rolling 12 months. So you would have to maintain the coverage until 2022 in order to be able to keep all of those funds in that plan. You cannot then in turn dissolve or stop that high deductible healthcare plan a few months into 2021. Otherwise, you would have to take a prorated distribution of the contribution depending on how many months you had it. So if you made a full contribution for 2020 and you only had the coverage for 5 months, you would take 3,500 divide by 12, multiply that by 4, and that would tell you how many months of prorated contributions you would be able to keep in that plan, and then you would have to pay taxes and penalties on what you additionally distribute. So that being a little bit complicated, let me bring this in for a little bit more of a simplified answer. So you have, with the HSA first day of the last month rule, you have to have your coverage bound and purchased by 12/1 of this year in order to make a full contribution for this year. You can make that contribution up until your filing deadline, and you have to maintain that coverage for a full rolling 12 months, or you have to take a prorated distribution of the months that you weren't covered. So for example, Ben enrolls in an HDHP plan 11/30/2020. He can contribute a full $3,500 to his HSA for 2020 and take the deduction on his tax return. If Ben loses HDHP coverage prior to 11/30/2021, he must take a prorated distribution of the HSA account. That distribution is then subject to taxes and a 10% excise tax penalty. So contributing to HSAs, they must be made in cash, especially with cryptocurrency and a few things coming about now. I've had questions of, hey, can I move funds from, can I use like cryptocurrency or gold or things to contribute to an HSA? Or especially because you're allowed to do a one-time rollover contribution from a traditional IRA or Roth IRA, you are allowed to, you cannot do that in kind. So you can't do it with a piece of property. You can't do it with a note or anything. It has to be only cash that's moved in for the contribution to an HSA. Now, the one-time rollover from a traditional or Roth is great, but keep in mind that it's going to be subject to the limits of the HSA. So you can only move over $3,550 for an individual and $6,900 for a family plan per year. So most of the time, it's a little bit better of a deal for you just to take the money out of your own personal pocket because you get an additional deduction. You can contribute to both a traditional IRA and an HSA in a given year. Typically, the tax benefit's going to be better if you can take it out of pocket and put it into the HSA. And what would really not be the best deal, again, personal finance aside, is if you take it out of a Roth IRA because you've already paid taxes on it, you got zero deduction for it, and then you're going to be restricted on what you can use those funds for in a tax-free distributable manner. So the traditional IRA really is typically going to be the best value if you want to do the one-time funding rollover. You cannot use a SEP or a simple for this, nor can you use a 401k for that one-time rollover. It's only Roth or traditional for that initial one-time funding rollover to an HSA. Now, contributions can be made by the employee or the employer on behalf of the employee. So with one of the earlier questions, can I offer an HSA to my employees? Yes, and you can contribute to it on behalf of the employee. Now, the employer contributions are not included in the employee's income, and the deductions would be taken at that point by the employer. So depending on how you want to work things out, employers can do it. Employee contributions are tax deductible. And the great thing is deductions can be taken even if you don't itemize. Now, this is kind of a moot point with the updated tax law that was passed back in 2018 that doubled the standard deduction for all households. The percentage of individuals that are now still itemizing with the doubled standard deduction is significantly less. But even if you do still itemize your deductions or you're a high wage earner, you're not going to be phased out of making a contribution to an HSA, and there is no deductibility phase out like there is with a traditional IRA for these types of plans as well. Although not a huge amount of deduction that you get for it, there still is the ability for that. So that's a nice little addition. Let's see. I have a question from Stephanie. I have a self-directed IRA. Can I make a contribution from it to the HSA? Yeah, absolutely. Whether or not it's self-directed has zero bearing on whether or not you can utilize that type of account for your one-time funding rollover. Keep in mind, though, that the particular tax benefit is still going to need to be weighed by you personally on whether or not that makes sense, or whether you'd like to capture an additional deduction by making it personally. And again, you have to make that contribution in cash. Let's see. Kind of a bigger question here. Let's unpack this one because it's we're pretty much done with this slide. Let me try to. Okay. So, but if one has an HSA and dies, how are the remaining funds in the HSA treated? For example, do the funds have to remain in an HSA? Or, for example, would I, if one of the beneficiaries would receive the remainder of the cash contribution? Not an nitpicky question, and we definitely do cover that a little bit later on in the presentation, but no time like the present to answer it. So, with an HSA, unfortunately, it is very restrictive with regards to your beneficiary options. The only person that could inherit a HSA from you as an HSA is a legally married spouse. So if you are legally married to another individual and you name them as the primary beneficiary, they can treat that HSA as their own. Now, anyone else, this includes dependents, this includes children, your neighbor Bob, a charity, they do not get to take this as an HSA. They can't even take it as an IRA. It just becomes simply distributable and taxable to them at the time of your death with regards to the inheritance that they receive from you. So that is one thing to look at if you're looking at estate planning, that anything that's in an HSA that is not being left to a spousal primary beneficiary is going to be a taxable deduction, is going to be a taxable event to those individuals that are named as the beneficiary. So again, not a nitpicky question, great question, definitely important to understand, especially with regard to estate and tax planning. Okay, contribution limits. So the HSA qualifying limits are going to be as follows. You get for self-only coverage 3,550. Sorry, there was a mid-year contribution limit update last year. It's $7,100 is the HSA contribution limit for a family. And if you're over 55, you get an additional 1,000 on top of either of those as well. We have someone asked, can a trust be a beneficiary of an HSA? It can, but keep in mind that that trust is then in turn going to have to file a tax return for any of the applicable cash that it receives from an HSA. Even if the beneficiary or primary beneficiary of that trust is a spouse, it would still be a taxable event. The only way to avoid that is to circumvent the trust and just have the primary spousal beneficiary named directly as the beneficiary of the HSA. But you can name anyone that you'd like as, or anyone or anything really, as that you'd like as the beneficiary of an HSA. The only real difference is going to be that the potential taxation of those funds that they receive, again, if they are a non-spousal beneficiary of that account. Okay, qualified medical expenses. We're going to go into detail, but if you would like to have a full list, feel free to ask. I might know it off the top of my head. I have read IRS publication 502. If you want the long enumerated list, and they list everything, and when I do mean everything, it is in alphabetical order, starting with A's, ending with Z's, and IRS publication 502. It's not that bad to read. It literally is pretty much just a big list of things that can be considered qualifying medical expenses for an HSA. So I'd include, I'd encourage you to read that if you don't see what you are thinking about answered here in this presentation. But your healthcare plan deductibles are qualified medical expenses you can use to reimburse yourself from an HSA. Cost of doctor visits, dental care, vision care. Now, keep in mind, dental and vision can only be reimbursed if you do not have other supplemental coverage for dental and vision. So if you have a vision plan and you still have out-of-pockets, you cannot use your HSA to reimburse yourself. Same things with dental. You go and get a root canal. You have to pay out-of-pocket 20% of your co-insurance for that procedure. You cannot reimburse yourself from the HSA for that other 20% out-of-pocket. Chiropractors are allowed. Bandages and other OTC first aid kits, disabled dependent care expenses, capital improvements to the home for the main purpose of medical care. You become disabled, you need to lower countertops, you need to put in a wheelchair ramp, you need to put in a, whatever they call the things that take people up and down stairs in like a motorized chair. Long-term care, psychiatric, psychology care, lodging and trip expenses for medical care. So if you need to travel to another state or city for a procedure that is not covered by any other insurance and is a qualified medical expense, you can pay for lodging and trip expenses for that medical care. So we got a question. Is IVF covered? I don't know, Fazil. I think that fertility treatments, so long as that they are one being received by a covered individual under the HDHP, and that individual is either a spouse or a covered dependent, I think it would be. I am not sure if it is or not. I know that with regards to some reproductive procedures, I'm not going to get into the specifics of them, but I know that they are delineated in publication 502. If you want to reference that for exactly what would or wouldn't be able to be covered in that. But I know it's not kind of across the board for reproductive procedures to be covered. Let's see. Would cosmetic plastic surgery costs cover non-medical health reason? If it's for a medical reason, I believe I did look up like something like a rhinoplasty for a deviated septum. Yes, if you did not have a legitimate medical reason, one thing would be augmentation of certain body parts. That is not covered. Also, things like liposuction for non-health related reasons. Teeth whitening and things like that, those all would not be able to be covered by an HSA or reimbursed. So if there's a legitimate health reason behind it, again, the deviated septum was kind of the easy one for ease of breathing. It's a procedure for your nose. Yeah, that kind of stuff could be, but again, other types of things, we'll go too far into detail on those, but if it does not have a health reason and is strictly for a vanity reason, then no, typically those would not be able to be covered. Non-qualified medical expenses, and that kind of gets directly into that and kind of covers a few other ones. Healthcare plan premiums, except for COBRA. So if you have an HSA qualifying plan and you lose your employment, you can pay your COBRA premiums with that HSA. Non-prescription drugs, unless you have a prescription for it. The easy one right here is that if you're prescribed, a very common one is ibuprofen, Advil, an anti-inflammatory. You know, you can, if you are written a prescription for that, you can use HSA to go buy that. But if you just want to go buy like some antacids or, you know, some Benadryl or something, you don't have a prescription for stuff like that, you cannot use an HSA for that. Weight loss programs, unless it is specifically um, uh, determined by bariatrics that you need this for immediate health reasons. Prescriptions, yes, they are covered. Stephanie, yes, prescription drugs are covered. Non-prescription drugs are not. Cosmetic surgery, teeth whitening, nutritional supplements. Again, unless you have a a um, a prescription for it. Good examples, things like fish oil and vitamin D. Um, Personally, my doctor wrote a prescription for that, so I can, you know, if I wanted to, use my HSA if I had one to reimburse myself for that. So it's not universal when I say nutritional supplements. You know, if you are written a prescription for something, it becomes a prescription medication. Whether or not you buy that over the counter or not is irrelevant. It is a prescription medication by virtue of that prescription, and you can use an HSA to pay for that. So just keep in mind that if need be, talk to your healthcare provider. If they tell you just, hey, I'd like you to start taking you know, fish oil and some vitamin D and some other things, ask them to write a prescription for it. And if they're willing to do that and you explain the reasons behind it, you can then use your HSA to pay for that stuff. I know from personal experience, some of those supplements can be pretty expensive depending on how often you take them. So it's always worth an ask. You know, talk to your healthcare provider because doctors aren't always as familiar with the financial side of healthcare coverage and these things as often they maybe always need to be. Or should be. So it's always worth bringing it up, talking to them. You know, if you learn something and they're not aware of it, everyone's the better for being educated. Babysitting, healthcare club dues, medical expenses reimbursed by an FSA or medical savings account. So again, you can't double dip if it's already been reimbursed by one type of an account under a different plan. You cannot then in turn reimburse yourself again for that same expense. And you also cannot pay for future medical expenses. So if, for instance, if you need to put a down payment for a medical procedure that you are paying for out of pocket, you have to then in turn pay that personally. Then after the procedure is done, you can either pay for the remainder with the HSA, you can pay for it out of pocket and then reimburse yourself. And we'll kind of get into some examples of what it looks like and what some of the advantages of reimbursing yourself down the road might actually look like. Okay, Jennifer asks, it is clear that an HSA is used for medical expenses. However, can an HSA, only in emergency, be used for emergency funds with the understanding that the money be returned to the account? If so, at what interest rate? Unfortunately, the answer to that is no. You are not able to access this for, you know, emergency funds. You can't take a loan against it. It is strictly for medical expenses. Now, if you are under the age of 65 and you need to take money out, you're going to be looking at paying income taxes on it, and you are going to then in turn have to pay a 10% early withdrawal excise tax penalty. However, if you are over the age of 65, you can treat this as a traditional IRA. So obviously, I don't know how old you are, but if anyone is out there and they're intrigued by this question, if you're over the age of 65, you can take taxable distributions without that 10% penalty once you're over the age of 65. Essentially, this kind of can turn into a hybrid uh, traditional IRA. Now, you can certainly reimburse yourself for expenses tax and penalty free at any time during this, so long as the expense was incurred during the life cycle of the coverage of the HDHP and while the HSA was indeed established, with the exception being the first day of the last month rule at the beginning of the HSA. Never said these plans are easy to understand. That's why we do classes on them. So there's definitely a lot that goes into them. And again, I encourage questions. All these questions have been fantastic, so keep them coming. I'm certainly happy to impart my knowledge that I have on these. Record keeping of expenses. Probably the single most important thing besides understanding your ability to have an HSA is understanding how to use this to get that great tax benefit of, one, getting the deduction on the way in and no taxes on the way out. You know, you get the best of a traditional and a Roth IRA in this. You get a deduction and no taxes. What do you have to do? Well, record keeping of expenses is paramount. Now, most of the time, people will utilize these plans and pay out of pocket over years for medical expenses and then reimburse themselves tax-free, because remember, all of the earnings accumulated within an HSA are completely tax-free. So you get a great tax benefit from keeping it in this tax shelter for as long as possible. But you have to record keep these expenses. If you want to take a tax and penalty-free distribution, you got to show the IRS that, hey, this indeed was incurred, during this proper life cycle. What does that mean? Keep your receipts. Make sure that the receipts are record kept securely. If you get a receipt on a piece of heat transfer paper, I know from unfortunate personal experience that those things can fade if left in a hot enough room. So make a copy of it, back it up, print it to paper on an inkjet, scan it to a folder, put it on a hard drive. Because at the end of the day, there is no oops, it was lost in a house fire, or I cannot find it. If you are audited and you are found to have done that, you might have to refile taxes, pay very hefty penalties and taxes on what was taken out. So it is incredibly important that you make sure you keep records of any expenses that you ever want to reimburse yourself from an HSA. Now, I maybe have a little bit of doom and gloom on how I'm saying that, but it is, besides understanding whether or not you can have one, it is absolutely the most important other aspect of having an HSA is record keeping your expenses, because you are responsible for that, no one else. If the doctor's office loses records, that's all well and good, but you are the individual that is responsible for maintaining records for reimbursement purposes. Oh, and one other thing, before we get off that, the medical expenses cannot be taken as an itemized deduction previously. So if you itemize a deduction and you included medical expenses on that, those medical expenses are no longer able to be reimbursed by an HSA. Distributions from an HSA. Now we'll get into the good stuff, which is not paying taxes and getting deductions on this stuff. So you can take a tax-free distribution anytime after the expense is incurred. So again, remember, you can't prepay stuff, but the second that you incur that expense, you can either pay at point of sale, or you can pay out of pocket and then continually let the funds in that HSA grow tax-free, and then take a tax-free distribution at a later date. HSA distributions are tax-free regardless of age or how long the health plan has been in existence, so long as these requirements are met. Distribution is for, again, qualified medical expense, so can be things like plastic surgery, OTC medication, things like that, and the expenses incurred after the HSA is established. Let's look at an example. Now we're kind of getting up on the end of this. I don't believe there's too many slides after I go through this example. This example is very detailed for a reason, but if you have any questions, fire them into this, and then I will cover those after we go through this example. It's a couple slides long. I just want to make sure we get through this unbroken, so that way people can kind of get it as one chunk of information. So Joe has an HSA. He opens self-only HSA and makes a full $3,400 deductible contribution in 2017. Joe has $1,000 of qualified medical expenses from May through the December of that year, 2017. And at the end of the year, takes a $1,000 distribution from his HSA tax-free. This leaves $2,400 plus earnings remaining in the HSA for future expenses. In 2018, Joe makes another $3,400 deductible contribution to an HSA. In March of that year, Joe has surgery costing $3,000 out of pocket. He takes an immediate distribution in March to pay expenses. Joe leaves $2,800 in the HSA and accumulates $500 of more expenses in 2018. Remember, he only took the distribution to pay expenses for that surgery and then had an additional $500 of expenses. So that $500 of expenses now is going to carry forward along with the other expenses that he had from the previous year. At the start of 2019, Joe has $2,800 plus earnings in the HSA and accumulated $500 of qualified medical expenses, but takes no reimbursement. In January, he makes a $3,400 deductible contribution to the HSA. So at this point, he has $2,800 plus earnings in the HSA. He then takes and puts in another $3,400, bringing his total cash balance up. And then he also has about $1,500 of qualified medical expenses that he has not taken a distribution for thus far. However, in the end of 2019, he has another $1,000 of qualified medical expenses, bringing the total qualified medical expenses that have not been reimbursed to $2,500. Now, Joe has $6,200 plus earnings in the HSA and $1,500 of expenses. Joe again makes his annual contribution and accumulates $1,000 of additional expenses. He takes no distribution from the HSA. Now, at the end of 2020, he has $2,500 or so of unreimbursed expenses and $6,200 plus earnings, remember, which he got deductions for the contributions and has paid no taxes on any of the earnings thus far. Skip ahead 10 years. At the beginning of the year, Joe has $60,000 in his HSA, contributions plus earnings from the previous 10 years. In the last 12 years, he has had $20,000 of qualified medical expenses, but took no distributions. In 2030, he takes $20,000 as a tax-free distribution from the HSA. Now, the following year, Joe decides he wants to remove some of the funds from his HSA, but has no for qualified expenses. What are his options? So, he has $40,000 in his HSA. He has no more medical expenses that he can reimburse himself from. What can he do? If he's under 65, the distributions from the HSA are subject to income tax and a 20% penalty. I believe I misspoke earlier. To take a non-qualified distribution under the age of 65, I said was 10%. It's actually a 20% penalty plus taxes. If Joe is over the age of 65 or has become deemed disabled, that can either be through your normal doctor, or if you are disabled deemed by the VA, you have to be on disability. You can exempt yourself from the 65 age requirement. The 20% penalty does not apply, but the distributions are going to be subject to income tax. All right. Okay, we got a question. Again, remember, I wanted just to get through that. I have an HSA. Let's see. Thomas asks, I have an HSA through my employer and cover our family with an HDHP. My wife has her own business. Her income is all 1099. Is she able to set up her own HSA through her company? Yes, but keep in mind with this that if it's HSA family coverage and she then in turn wants to start her own HSA coverage, one, she'd need to remove herself from the coverage of that plan, which might change the status of that plan. If you no longer have any dependents, typically if you have children and they've moved out or they are aged out of being covered by this HDHP HSA plan, then excuse me, then your coverage would change from family to solo, and hers would automatically be individual coverage as well. So you couldn't maintain a family plan and her have her own individual one if you had no other dependents that were covered under that plan. So yes, she can absolutely set up her own HDHP plan. She would need to buy healthcare coverage individually, typically through the marketplace. The ACA open enrollment marketplace, which starts Sunday. Yeah, Sunday's the first. So she could do that, but there's kind of a lot more to unpack with that. It might not necessarily be better for her to start her own if it's going to reduce the amount of contributions that potentially y'all are able to make. So the answer, I would say, to your question, Thomas, is yes, but kind of with an asterisk. Let's see. Jennifer asked, can HSA funds be used to pay for long-term healthcare insurance? Well, that really kind of depends on what the insurance would be. Typically, long-term health or dependent or kind of like geriatric care or like in-service stuff. Typically, yes, but there can be some carve-outs to that. I would essentially refer you over to publication 502 from the IRS, or contact the plan provider for that and ask if it's HSA qualifying payments to that. Because again, they should know, or the 502 IRS publication should be able to answer that pretty well. Don't be afraid of the publication 502. Although it maybe isn't as entertaining as reading Harry Potter, it's not terribly difficult to get through. It's pretty well written. So as far as IRS stuff goes, it's not super complicated. Let's see. We have, do you know if the recent CARES Act on early withdrawal from retirement accounts will be free of penalty up to 100,000. Would that include HSAs? That does not include HSAs. I also teach several different classes on the CARES Act and what that means. The retirement accounts that you're referring to is withdrawals from employer-sponsored plans of up to $100,000 or participant loans that have been augmented for employers to be able to augment their plan document to allow for that. But that has nothing to do with HSAs. They were not covered with any type of exemptions or changes with regards to the CARES Act. Good question, though. How long do you recommend we keep records after the expense is incurred? Is this dependent on whether you decide to take the distribution for the expense? Exactly, Stephanie. I'd recommend you keep it for as long as you plan on ever taking a reimbursement for it, because if you get rid of the records of that expense and then you want to take a distribution to reimburse yourself, then you're kind of out of luck. So it's kind of on you to determine what exactly that is going to look like for you individually. If you say, hey, this $10 ACE bandage from when I tore my ACL, I don't really need to reimburse myself for anymore, then yeah, get rid of it. But if you're talking thousands of dollars or stuff like that, it's kind of cheap insurance to maintain records securely in today's day and age, with cloud storage and the cheapness of the physical storage devices like hard drives and things like that. So I'm kind of, maybe someone might call me overly cautious, but I keep everything and I back it up 3 different places. So that's me. Again, your mileage may vary, but the short answer is that if you ever want to take a distribution to reimburse yourself, is how long you need to keep that record for. But I guess also to the other point is that if you don't plan on taking a distribution for it, you don't necessarily need to record keep it. And if you do take a distribution, I would recommend that you keep it and then maybe also file that as an addendum with your 1040. So that way the IRS has a copy of it. So you don't necessarily need to be on the hook for maintaining records after you've taken a distribution for that expense. Where can we set up an HSA, Maria? Well, we can do it right here at Advanta. We specialize in any type of retirement account, and we can certainly help you out with an HSA. Naming a beneficiary of your HSA, we're getting kind of tight on time, so fire the questions off, and then I will answer those at the end. I just want to get through some of these slides here. If you name a spouse as a beneficiary, then the spouse can treat their HSA as their own. Use it for qualified medical expenses. We kind of covered that. For a non-spouse beneficiary, the HSA ceases to be an HSA account. So again, for anyone that's not a spouse, that includes a trust. The value of the HSA is taxable to the beneficiary in the year in which you die. If you're saved as a beneficiary, the value of the HSA is included in your final tax return and your probatable assets. Now, how can you invest these funds? Well, that's what we specialize in, is offering you the alternatives to just having stocks, bonds, mutual funds, things like that. We have clients that own rental portfolios and precious metals in their HSAs. So if you'd like to kind of invest the money and watch it grow outside of the rather volatile stock market, which just had its biggest single day drop, I believe, since March on Tuesday. Maybe misquoting, we had a pretty significant drop on the major indexes. We offer alternatives to buying securities. So if you're interested in things like that, please let us know. We can absolutely help you out with it. There's certain things that you can't buy. There would be life insurance, collectibles, antiques, alcohol, artwork, stamps, are things that you cannot buy within an HSA. There's certain people you cannot invest with. You cannot directly buy or sell anything from yourself or your spouse. You cannot buy or sell anything to a lineal descendant or ascendant of you personally. So children, parents, grandparents, spouses, or any business entity owned or controlled by yourself. Okay, Maria, yeah, since we are getting right to the end of this, I'm going to, if you'd like to get in touch with me directly, we'll go through this HSA case study quickly, and then I'll get my contact information up there for you. So a lot of clients that would invest with us, they're interested in doing things involving real estate or other alternatives. So in this case, Heather wants to invest in real estate, and she has $20,000 in an HSA that's currently invested in mutual funds, and she doesn't have any expenses coming up recently that she would need to utilize this specific set of funds for. So she'd realize better returns lending the money on a note, so she decides to lend out the funds. She meets Steve. Steve's looking for an investment partner. He's acquired a property for rehab. Steve needs $20,000 for rehab costs to then sell the property. So she, in turn, then is going to lend Steve $20,000 from her HSA and split the profits when the property sells. So the terms of this deal are as follows. She lends $20,000 to Steve for 25% of the profits on the property when it sells. She gets a secured first mortgage to her HSA, and then once the property sells, the total proceeds, the total profits on the sale are 30 grand, and the tax-free income back to Heather's HSA is $7,500. So Heather then has $27,500 in her HSA that she can use to pay for qualified medical expenses that she incurred since she started the HSA, or she can continue to invest and grow everything tax-free, and then also take tax-free distributions once the HSA, once she decides to reimburse herself for qualifying medical expenses, or obviously taxable distributions once she's 65. So if you're interested in learning any more, I am always happy to assist you, or you can go to our website, and any of our main things in our learning center will be able to help you with that. Any of our events, we have all these videos cataloged, so this will be on our YouTube channel, on our on-demand portion of our website if you want to go back and reference this. If you'd like to get started with an HSA, it is incredibly simple. You just need to contact me, and it's just a matter of opening the account, either transferring over from another HSA or just funding it directly here, and then you're ready to go. So if you do want to get in touch with me, all my contact information is up here directly on the screen in front of you. I see we have a couple questions, and I'll stick around as long as there are any other questions. Yeah, Sarah, unfortunately, I forgot to upload this as a handout. I normally upload my slides as a handout to my presentations, but if you would like it, just shoot me an email, and I can send you over a PDF copy of the slides. So if anyone is interested in that, just jot down my email. If you are listening to this audio only, it is P as in Paul, ERNY at Advanta IRA.com. Or you can give me a call at 727-754-9954, and I can get you your information and get you the slides as well. So if anyone has any questions, I will stick around here until we have not too many more people on the presentation, but that's pretty much it. Just remember, everyone, that open enrollment starts on Sundays, November 1st. I know it's crazy. 2020 has been quite an interesting year, and the fact that it is, we're getting into the last 2 months of the year is pretty wild. But open enrollment does start then. I believe it runs through December 15th or 14th. So you have, it's typically about 45 days that you have for open enrollment through the Affordable Care Act open marketplace for open enrollment. So if you're looking to do that and you need to get new coverage, now is the time to start looking and doing that, especially if you want to learn more about HSAs and the like. So again, I'll stick around here for any questions until we have just probably about 10 or so people on, and then I will close it down. Thank you, everyone, for joining. Hope you have a great rest of your day. And if you are going to be enjoying Halloween this weekend, have a safe and enjoyable celebration.